We are covering inflation risk, liquidity risk, and opportunity cost as tested on the Series 65 exam. These concepts are crucial for making suitable investment recommendations, a core duty of an investment advisor representative. First, let's tackle inflation risk, which is also called purchasing power risk. This is the risk that the return on an investment will not keep pace with the rising costs of goods and services, effectively reducing what your money can buy in the future. The exam will test this by asking you to differentiate between a nominal return, which is the stated rate of return, and the real return, which is the nominal return minus the inflation rate. For example, if a bond portfolio yields 4% but inflation is 3%, the real return is only 1%. An exam question might present a retiree who needs their portfolio to last for 30 years and is invested solely in these bonds. This would be an unsuitable recommendation because the low real return is being dangerously eroded by inflation risk, jeopardizing their long-term goals. The trap is focusing on the positive 4% nominal yield while ignoring the destructive effect of inflation. Next is liquidity risk. This is the risk that you cannot sell an asset quickly at a fair market price. The most direct measure of liquidity risk you'll see on the exam is the bid-ask spread. A wide spread between the bid price, what a buyer is willing to pay, and the ask price, what a seller is willing to accept, indicates poor liquidity. A common exam scenario involves an advisor recommending an illiquid investment, like a non-traded real estate investment trust or a limited partnership, to a client who has short-term cash needs, such as a down payment on a house. This is a classic suitability violation. The test wants you to recognize that even if the investment itself is sound, its lack of liquidity makes it inappropriate for that specific client's time horizon. Finally, there's opportunity cost, which is a more subtle but equally important concept. Opportunity cost is the value of the next best alternative that you gave up. The exam tests this in the context of portfolio decisions. For instance, a client holds a very large sum of money in a low-yielding savings account for years. While this feels safe, the opportunity cost is the significantly higher return they could have earned by investing in a diversified portfolio aligned with their risk tolerance. An advisor who fails to address this is not acting in the client's best interest. To keep these straight, use this mental shortcut, ILO. Inflation is the invisible thief, liquidity is your access to cash, and opportunity is the path not taken. Remembering to check for ILO helps ensure your recommendations are always suitable. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.